Hi, everyone. Thank you so much for tuning in. I'm so excited about our topic today. We're going to be talking about the long put option. But first, I want to welcome back all of our subscribers and a very warm welcome if this is your very first time here. My name is Kirk with Tactical Options Trading, and we make videos like this all the time where we talk about the stock market and options trading. And I hope you'll consider subscribing and clicking that bell so that you do not miss out on any future videos. All right, let's get started, you guys. We're talking about the long put option. So what is a long put option strategy? So the long put option strategy is probably the second most simple and easy to understand option strategy there is next to the long call. So a lot of us are familiar with the long call option, but not too many people are used to using a long put option strategy. So let's talk about it. So it consists of buying a put option with the belief that the price of the underlying stock will fall significantly below the strike price before option expiration. So let's just take a look at a profit loss diagram here of a long put option. So you can see on the long put option, we are expecting this stock to trade down. So here's the stock price here, and you can see on the stock price on this line, we are expecting this stock to trade lower into the future, and we're buying a strike price here, and in this example, we're buying the $40 strike and expecting that stock to trade lower. But we're going to talk about this a little bit more in the video, but I wanted to kind of give you an idea before we get started here what the profit loss diagram looks like. All right, profit potential in a long put option. So the profit potential when trading a long put is limited by the stock going to zero. So obviously the stock can only go to zero, so our profit potential is capped by that stock hitting that zero mark. Whereas on a long call, a stock can rise indefinitely, and so our potential to make profit, or our profit potential, I should say, in that long call is unlimited. All right, the profit formula. How do we calculate our profit? So we realize a profit if the stock price is less than the strike price plus the premium paid. All right, let's go back to our profit loss diagram here. So in this example, we bought the 40 put. We're expecting that stock to go down, and we paid a debit in our account, of $200. So what we need that stock to do is to trade down at least $2. So you remember, when we're trading options, each option contract is worth 100 shares of stock, or it controls 100 shares of stock. So $2 would be the equivalent of $200 in option talk. So we bought the 40 put. We need that stock to trade down $2 to this $38 mark, and then after that, everything above that point, or I'm sorry, I should say below that point, anything that stock does below that point to trade down is going to be profit to us. But we at least have to make that $38 break even point, because we paid $2. So we take that 40 and then we minus the $2 to get down to 38, and anything below that 38 would be profit in the long put option. All right, so limited risk. What is our risk in trading the long put option? Our risk is simply limited to the price that we paid for that option. So you remember, in this particular example, we paid $200 to buy that put option, and that's the amount of our risk in the trade. So we cannot lose any more than that if we are a buyer of the put option. So let's again look at that. Profit loss diagram. But first, I wanted to just remind you that the maximum loss occurs when the underlying stock is greater than the strike price of our long put. So again, looking at that profit loss diagram, you can see here is our long put that we bought. Now, if that stock were to trade up in value, the stock price were to rise above our 40 put, then we're capped at our loss of $200. So that's the max we paid, or that's what we paid. That's our max loss in this case. Is anything above that 40 put at expiration would be a loss of $200, and that's our max loss in this trade. All right, so our break-even point, we've kind of already talked about that. So the formula for calculating the break-even point is as follows. So our break-even point is the strike price plus the premium paid, which for a put option is below the strike price. And obviously we just talked about that. Here's our $40 put. We paid $200, or we paid $2 premium for that one option. So we need the stock to decrease in value, the stock price to decrease in value to $38, and anything below that would be a profit. So we need $38 would be our break-even point in this case. So why do we trade options? You know, we trade options because of leverage. And so I wanted to point out here that the option buyer, when buying a put option, will gain leverage in comparison to just shorting the shares of a stock outright. So a buyer of a single put option with the lower price will control 100 shares of the underlying stock, which percentage-wise will appreciate faster than just shorting the stock outright. However, put options expire, and if the underlying stock does not move below the strike price at expiration, then the option will become worthless. All right, guys, I wanted to show you a stock chart here just so we can kind of put this in action. So I have a stock chart here of XHB. Now, when I bring this up, I want to point out I'm not recommending trading XHB. I'm just using this for educational purposes. So this is only educational purposes only. But let's say, for example, we saw this stock rise and it hit this resistance here, and now we're looking for that stock to trade lower because we've come into some resistance, and now we're expecting that stock, as it hit resistance, as it has in the past, it hit that resistance, came down, bounced, and then up again, down. It's hit this resistance, and we're expecting this stock to trade lower. So in our example, in that profit loss diagram, we were talking about buying a 40 put. So let's say, for example, this stock right now is trading directly at $40. So if we bought the at the money put at $40, expecting that stock to go down, let's put that into our profit loss diagram and see how that looks. So if we come over here to the trade tab, we look at the 40 put, and we go ahead and we purchase that 40 put. So we're going to click that 40, we're going to put it in our trade order down here, and we're going to pay 93 cents to buy that put. Now let's go ahead and put it in the Analyze tab, and here's that profit and loss diagram that we were looking at on those other pages. So you can see here that we paid our $40 put option. In order for us to make any money, it has to come out to this line right here. You can see right on this chart. Let me get a little bit closer look here for you. Right here, this red line, you can see that the stock would need to drop down approximately 93 cents is what we paid, so almost $1. So from that $40 down to 39 or just under $39 until we break even. So this kind of a green line here is our stock at expiration day, or our option at expiration day. So this is where we would need to be at expiration or below in order to break even or make money in this case. Guys, I hope you've enjoyed this video. I hope it has helped you in some way. Again, I hope you consider subscribing. We make videos like this all the time. My name is Kirk with Tactical Options Trading. We'll catch you next time. Thanks for joining me.